Welcome back to EDS, and in this video I'm going to show you the easiest way to write options contracts in 2025 so you can collect premium and generate consistent returns. So the first thing you want to do is pull up any equities underlying in your brokerage account. The one that we're going to go with is EWZ. It doesn't matter what you pick, we just want to see the list of expiration dates for EWZ. All equities have the same expiration dates, that's why it doesn't matter which one you go for. Now, the expiration date that we want to pick needs to be between 30 and 60 days out in time. Ideally around 45 days, but anywhere between 30 and 60 days is fine. It also needs to be a monthly, not a weekly or quarterly expiration date, and the only expiration date that fits that criteria right now is February 21st with 46 days left on the contract. So what we want to do is come over to our watch list and simply filter out any and all underlyings that have an earnings event within 46 days. Now the reason for this is because leading up to earnings, we will have an increase in volatility, and as volatility increases, option prices increase, and we are shorting the contracts, which means we want to sell high, buy low. So if we've sold a contract and the volatility increases whilst we're in that contract, that's going to have a negative effect on our P&L. We also want to filter out anything with a low liquidity rating level. The reason for this is because we only want to trade liquid markets. The more liquid the market is, or a market is, the tighter the bid-ask spread is, and the tighter the bid-ask spread, the less you pay to get in and get out of a position, meaning that you keep more profit in your pocket. So that's why we do that, and this is just a matter of personal preference, but I like to order everything from high to low IV rank. We want to sell, of course, when volatility or implied volatility is high, and IV rank is a metric or an indicator that we can use to see where IV is relative to itself for that specific underlying over the past year. Now, typically anything over 30 can be considered high. Over 50 is definitely high. So just keep that in mind. And we want to go down the list and see what would fit well in our portfolio. You don't want to be too heavy in any one industry or sector. So keep that in mind when you are going through this list. Now, I did have my eye on TLT a little bit earlier. It's trading at just under $87 a share. It's got a nice IV rank of 47.1, so plenty of volatility or implied volatility. It's got an absolute IV level of 16.4%. So if you just open up TLT, the expiration dates for TLT, we already know where we're going to be, February 21st. This is why we selected an expiration date at the beginning. So February 21st, 46 days out, that's where we're going to be. And at this point, we can see the options chain. Now, this orange horizontal line shows us where the price of TLT is with respect to the strikes. The strikes are here in the middle. And this vertical orange bar shows us what the expected move is of TLT over the next 46 days. Now, what do we do here? How do we make money? Well, we want to sell some contracts. We're going to sell one call and one put to keep it very simple. And how do we know where to sell them? Well, we want to have a high probability of success. So when we're writing contracts, we don't want price to go near our contracts. We don't want price to breach our contracts. We want price to stay away. So if we know what the expected move is, all we have to do is sell some contracts outside of the expected move, and that's going to give us a high probability of success. Now, we also have these one standard deviation levels here marked in blue, and we want to be kind of around the one standard deviation level outside of the expected move, and we can also use delta as well. So I personally like to be anywhere between 15 and 20 deltas when it comes to selecting selecting strikes. So all three things, the expected move, the standard deviations, and delta, will line up almost every single time on every underlying for every position. So If we look on the delta column, we've got a 17 delta here at the 92 strike, which is outside of the expected move, and it's just on the edge of the 1 standard deviation level. And on the put side, we have a 19 delta. In fact, let's be slightly more conservative to begin with. We've got a 15 delta here at the 82 strike, again right at the edge of the 1 standard deviation level and also outside of the expected move. So what we've done is we've created a range for ourselves between $82 and $92. And as long as price stays within this range at expiration, we will make money. We will keep all of the premium that we collect up front. Now, what is the probability of this happening? Now, if we look in the bottom left corner above our order, we have a pop of 74%. Pop is probability of profit, which means that at expiration we have a 74% chance of making at least 1 penny on this position at some point over the next 46 days. Now, if we don't want to wait all the way to the expiration and we want to get out a little bit early, say at 50% of max profit, then we have a P50 here, which is the probability of hitting 50% of max profit, and that's 86%. So we've got probabilities of success between 74 and 86%. So we are looking at very, very high probabilities of success, and we haven't even got filled yet. We already know that we have a solid trade setup here that is probably going to work in our favor. And now, what is the actual premium that we can collect? How much money can we make off this position? Well, if we look in the bottom middle here, it says 83 cents. Now, this is the premium that we would collect per share. Now, each contract controls 100 shares of the underlying, so you'd multiply that out by 100, and we get our max profit here of $83. Well, $82. Price has just changed. $82, and we're back up to $83 now. And our broker is going to require us to have $1,239.80 tied up in order to open this position. Now, as we can see here, this is a slightly lower return on capital than what we usually showcase when we're mocking up positions. However, TLT is nice to have in your portfolio. You want to have a mix of, individual companies. For example, if this was MicroStrategy or Tesla or something like that, you would have a higher return on capital. With something like TLT or ETFs in general, you typically have a lower return on capital, but your P&L curve will be smoother because price doesn't move around as violently as with other underlyings. So it's good to have a mix in your portfolio. Now, if you wanted to be a bit more aggressive on this position, you could move the put side up to 19 delta and collect a bit more premium up front, get a slightly better return on capital. Really and truly, you could also do the same thing. You could even push it to a 23 and 25 delta on both sides. This in itself wouldn't be a bad position, simply just because it is TLT. So you can be a little bit more aggressive and collect more premium up front, and you will get an even higher return on capital. Now we're getting close to a 10% mark on the return on capital. Now, this will reduce your probabilities of success slightly, but we still have a pop of 64% and a P50 of between 76 and 80%. It's flickering between 76 and 80%. So this is how you can kind of maneuver your positions, and when it comes to writing options contracts, everything is malleable, so you can move things around and fit it to your portfolio. Now, if you don't like this unlimited max loss potential, or the buying power requirement is too much, say for example if you have a smaller account, that's absolutely fine. What you can do is you can simply use some of this premium to buy another contract a little bit further out. So let's say if we go $2 wide, so we go to the 93 on the call side and we buy that contract, and we go $2 out on the put side, so we go to 82 and buy that contract. We've now used some of this premium to pay for these long contracts. However, what we've done is we no longer have an unlimited loss potential. We have a defined loss now, or a defined max risk. which is calculated by looking at the spread between our long and short contracts, which is $2, minus the premium that we collect up front, multiplied out by 100 because that's the contract multiplier, and we get a max loss of 137. Our broker knows that our max loss is now 137, and so it only needs to hold that much in buying power to open this position. And as you can see, our requirement has gone down from 1.3, 1.4k all the way down to $137, which will fit in pretty much every single portfolio, no matter how big or small your portfolio is, unless if it was extremely small. But I believe you probably would struggle to get a margin account open with most brokers if you have less than, a couple $1,000s in your account anyway. But the point is, we significantly reduce our buying power requirement, and we now have a max profit of $62 and a buying power requirement of $137. So our return on capital has improved massively. In exchange for this, our POP has dropped to 56% and our P50 has dropped just slightly to between 72 and 75%. So we get a higher return on capital, but slightly lower probabilities of success, and that's the trade-off. And we also have a lower capital requirement. There's a case to be argued that a position like this is more capital efficient. So this is how you can find and manipulate positions to fit inside your portfolio, and you want to just do this over and over and over again in your portfolio. Have as many number of occurrences as you possibly can, and let the odds just work out, let the probabilities work out in your favor, similar to a casino or an insurance company. Now, how do you know how much buying power you should be allocating to your positions? Well, in order to figure that out, we've got a free position sizing template. The link for this will be in the description, and it will take you to a spreadsheet that looks like this. And the way it works is you enter in the size of your portfolio, and then you enter in whatever the current VIX level is, and everything below will then be automatically calculated for you. It will tell you the maximum amount of buying power that you should be allocating to a single defined risk position, undefined risk position, how much of your portfolio you should be allocating to short premium strategies in general. And as long as you follow this spreadsheet, you will be absolutely fine over the long run. And if you want to learn in more detail about what we do and how we do it, again, link will be in the description. This time click on EDS Premium, get yourself signed up. Inside you'll have access to our portfolios that will allow you to see the positions that we're placing, how we're managing risk, the adjustments that we're making, all in real time. There's also a full course, so no prior knowledge is required. We will teach you everything that you need to know from start to finish. It is a private community, so you can speak with myself directly or with other like-minded individuals if you get stuck at any point. There's also a 100% money back guarantee. So if after 6 months you've gone through the whole course and followed some of our trades, if at that point you're not profitable, then we will work with you for free until you are, or you can just simply request a full refund. So it's completely risk-free on your part, and right now it's £1 a month to join. The price will be increasing, however, once you're inside, the price is locked in for you for life, so you are definitely rewarded for getting in early. And the aim of EDS Premium is to teach you the skill of what to do, how to do it, and what to do when things go wrong as well. A lot of the money that you make in this game will be dependent on how you manage risk and how you make adjustments when positions move against you. And we aim to get you to a point where you are completely self-sufficient. You've learned the skill. It's something that no one could take away from you for the rest of your life. And we aim to get you to that point within 6 to 12 months. You're always welcome to stay and be a part of the community. However, 6 to 12 months and you should be good to go. So with that being said, I will see you guys on the inside.